Okay, so I've started recording. So you're welcome to today's class. And in this class, we're going to talk about the price momentum divergence. In the previous class, or in the previous classes, we looked at we started with the introduction to technical analysis. We talked about trend, and we talked about trend analysis, right? And then, of course, we talked about other stuffs like trend lines and all that. We talked about support and resistance. And the last class we started building a sort of trading strategy that we can use to trade. And we, of course, looked at some of the ingredients, I'll put it that way, ingredient that we're going to use to cook up that strategy. It's just like when you are cooking something, you need the ingredients to be in the right proportion, to be ready, well washed, well cleaned, and be well prepared before you now start putting those ingredients together to make that delicious food, right? So we looked at some of those ingredients last week that we talked about. Of course, we did a revision on trend analysis, all right? And we said that the strategy we want to build it's such that follows the trend, all right? The ones that uh, allows us to trade impulsive moves in the direction of the trend. So that means when the market is in a range, we don't get involved in such market. We only be involved in a market that is trending. So we talked about that. And then when I started looking at the tools that can help us to do just that. And then we talked about the moving average, right? And I took us through what the moving average is and how traditionally people make use of them from the textbooks that we read. And then we talked about how we are going to be using it. We're going to use it, have two uses for it. The first one is we're going to use the moving average to help us identify the market trend, right? So which means that it's going to help us to select what kind of direction we want to trade, all right, in the direction of the trend, of course. So the moving average will help us to identify that. And secondly, the moving average is also going to be used as a sort of support and resistance. So that means when price is trending and it's in a correction like this, um, price is trending like this, it's going down, up, down, is in a downward trend. So we can use our moving average to identify what price levels, okay, the correction could get to before we start trading downwards, right? So we talked about how to use the moving average to do just that. And then when we look at the strategy as a whole and we put everything together, you're going to understand this even much better. And then we look at a moment, because moving average is a trend indicator. We also looked at momentum indicators. We look at the RSI and the stochastic. We look at the RSI and the stochastic oscillator. And we said that these indicators can help us to identify when the correction has become so exhausted. All right. We said that we, of course, talked about the overbought and oversold market condition. And we said that we're only going to trade overbought when the market is trending up at the end of a correction. We trade overbought of that correction using the RSI or the stochastic, and then we buy. Okay, wait for another correction, check the RSI oversold rather. This for oversold. So we only use the oversold in the trending market to identify the possible end of a correction so that we can take advantage of the next impulse. We talked about that, right? And of course, in the bullish market, we don't do overbought. We don't trade overbought signals. We only trade oversold signals. And of course, also when the market is trending down, for example, the market is trending down, we don't make use of the oversold signal. We make use of the overbought signal for us to identify where the corrections could end so that we can trade the next input, because that is the idea. We want to trade these impulsive moves, all those moves in the direction of the trend. We don't want to trade this corrective move. Okay, so that's why for a bearish trend, the overbought condition is is important to us, and for a bullish trend, the oversold condition is important to us. So that was what we talked about. And before we put all of these things together, which I think might actually be in the next class, I want to quickly take us through um, the other tool, all right? Apart from the RSI and the stochastic, there's one other ingredients that we need to learn. Okay, so we've learned these three ingredients now: trend analysis, moving average, RSI, and stochastic. So the next thing we want to learn now is what we call price momentum divergence. All right. Now, this is one of my favorite technical analysis tool. I use it not just for this strategy, but for other strategies in my trading kit. Okay. And there are also a lot of traders, whether technical or fundamental, who like spotting divergence between the price itself and the momentum indicator. Okay. So what is a divergence used for? Let's talk about what we can use it for before we talked about what it is and how we can identify it. Now, when the market is moving up and down, now, according to technical analysis, there are some signals that can help us to identify the end of these joints. I call them joints, so to speak, or support and resistance, so to speak. All right, support and resistance or joint or whatever you want to call it. Those are the points where a bullish trend turns bearish, a bearish turn bullish, a bullish turn bearish, and so on and so forth. Now, there are some signals, there are some technical signals that traders use to identify the end of these joints here. We call them reversal signals, reversal price patterns, reversal. Call them reversal price patterns. So these reversal price patterns, they help us to identify turning points in the direction of what turning point on the chart, turning point from the bullish move to the bearish move, or from the bearish move to the bullish move. These are turning points. So these reversal signals, they help us to identify those turning points. And so we now use one of the most popular reversal signal that we use in this regard is the price momentum divergence. So it's not the only one, okay? It's not the only one that people use, that traders use, but it's one of the most popular and one of the most effective, okay, among all the different reversal patterns, price pattern or chart patterns that we use in technical analysis. So that is what it's used for. Okay, does that make sense to us? I hope we understand that. Okay, so let's now look at what it is. Now, when you look at the charts, so I'm going to draw, let's do it like this. So we have two spaces here, just like I showed us last week when we are talking about the RSI and the stochastic. We know that the chart itself is up while the stochastic, the momentum indicators are below on the Metal Trader 4. So that means they are not on the same page. They don't use the same, how will I put it now? They don't use the same chart scale. All right, they're not on the same place, just like the moving average and the price. Moving average is plotted on the price page, price window. Okay, but the momentum indicators, they have their own window separately. All right. So we're going to just try to build up something. Let's say we have our RSI. Let's use the RSI, and this is the overbought region for the RSI, which is, let's say this from 70 upwards. And also, this is our oversold region for the RSI. Let me pick. So let's say that's our oversold region for the RSI and the overbought region for the RSI. The sizes are different. I'm not trying to draw them to scale, all right? I'm just trying to make illustration, all right? And then the price is up. So let's say this is what is demarcating the price. Let me actually use something better. Okay, let me use a different color. Okay, so what I'm trying to do here is trying to demarcate. All right. Oh, okay. So above is the price. Above this demarcation line is the price. Below this demarcation line is the momentum indicator. Let's say the RSI. And right here, we have the overbought region, which is for the RSI, just like we said, from 70 to 100. And then we have the oversold region, which is from 30 down to 0, right? And we know that, of course, price moves this way, all right? Go up and down just within this range, all right? This is how price goes. So we now say that once price gets to the overbought, we assume it's going to go down. When it goes to the oversold, we assume it's going to go up. Okay, but we'll make sure that we use that from the context of trend analysis, right? We talked about that it's only we only use oversold when the price is trending up like this, and we can use oversold for this. And we also use overbought when the price is trending down, and we use that for the end of these corrections. Yeah, right. Just trying to remind us all those things again. All right, so that's how price moves. And one thing you're also going to notice is that I mean, that's how the momentum indicator moves. Now, one thing you're going to notice is that there is a very clear similarity, okay, in the way the price moves and the way the momentum moves, because of course, the momentum indicator is derived, okay, from the price parameter, right? Just like the RSI is derived from a different formula for different purposes. So that means when price is going up like this, giving us a higher high like this, you would also going to expect the indicator to also give us a higher high like this. Okay, that's a normal price move, a normal price momentum move. Okay, so if the price again gives us from this high now gives us a lower low, the momentum also is going to give us what? A lower low most times. I mean, that's just a normal thing. Now, if the price moves up again to give us another higher high like this, you're going to see the momentum also move up to give us a higher high. Now, when it gets to this extreme level, because since we want to use the divergence, okay, let me explain what the divergence is before I go into that. Now, at the extreme level, whether at the overbought region or the oversold region, if the price makes higher high there, you expect the momentum also to make higher high. But there are some times that is not going to be the case. Sometimes what you're going to see the price does is, of course, it's going to make the higher high, like we have here. But instead of this one to give us a higher high, it now gives us a lower high. Let's say it now gives us a lower high like this. It goes up like this and something like this. So what happens there? This one is giving us a higher high. This is the high here. This is the high here. The last two highs, they are higher highs. But instead of the momentum to also give us the higher high like this, what it does is it gives us a lower high. So this is the high and this is the high. These are the last two highs, the two most recent highs. But in this case, this second high is lower than this first high. That is a lower high. When we looked at trend analysis, we talked about these higher highs and all those things. All right. Okay, that's why it's important that we do all these things step by step. So if we had not really talked about trend analysis, or if we're not in the trend analysis class, you might not really be able to get what we're trying to talk about here, right? So the price is making higher high, and then the momentum instead is giving us a lower high. So you have price giving us a higher high, and then you have the RSI. It could be RSI, it could be any other momentum indicator. It's not giving us a lower high. Lower high at where? At the overbought region. Or let's say around the overbought region. Sorry for my writing. Okay, so price is giving us a higher high. The RSI is giving us a lower high around the overbought region. Price is giving us a higher high. The RSI is giving us a lower high around the overbought region. Now, that's what we call a bearish divergence. That means it gives a bearish reversal signal. That's what it means. So that means it gives us a bearish reversal signal. That's what it means. All right. So that's what it means. It means a bearish reversal signal. All right. So let me take it again. Price gives us a higher high. As price is going up, it's going up, and at some point it gives us a higher high. But instead of the momentum to give us a higher high, it now gives us a lower high. All right. So that means this one is up like this. Let me use another color. This one is up like this, and this one is what? Low. Higher high, lower high. Now that is what we call a bearish divergence, and it means a bearish signal. All right. Do you guys understand it? If you understand this, type 1. Let me know that it makes sense to you. So when we are done with that, we're now going to look at the different varieties of bearish divergences that we could see before we now look at the bullish divergence and its varieties as well. Okay, I'm only seeing one from one person. So if it makes sense to you, if you understand what I'm saying, just drop one. Okay. Oh, okay. So I'm glad that we have more ones. All right. So thank you very much. So that is what a bullish divergence, a bearish divergence means. Okay. So don't forget the definition. At the beginning like this, you are going to, of course, make use of, we're going to be talking about definitions and all that. All right. But they are really very simple. So, okay. So what are the different varieties that we can now have? Okay. Now we can have another one like this, whereby the price makes maybe a higher high, but this high here is not that, it doesn't really break above this one. Let's say giving us a eye, the two eyes are really very close like this. Look at them. When you connect them, they are flat instead of going up like this. Okay. They are kind of flat when you connect them. All right. And for this one, instead of this one to go maybe flat as well, or maybe give us a bit of a higher high or something. Instead of that, it still maintains a lower low at the overbought region. And when you connect them, why this one gives us, this one gives us a flat top like this. This one give us this. Now that's also a divergence. All right. That's also a divergence there. It's just that in the first scenario, we had a higher high, but in this case, we have these two eyes around the same level, maybe this one slightly higher than this. You can get a variety of divergence like that. Now, in the market, it's not, things are not really perfect, okay, like that all the time. There are sometimes you're going to see them very perfect. There are sometimes they're not really going to be as perfect. And from experience, we cannot look for different varieties, things that are really, really very close to what we used to see. So this is a variety of a divergence, all right, of a bearish divergence. So in this case, it's bearish. So that means on the price, you could have higher high, on the momentum, lower high, that's a divergence. Or on the price, you can have flat high and still lower high here. Okay. So for the two cases, you have a bearish divergence. All right. And when you see that in a price, in a market that is moving up, it means that there is most likely going to be a bearish reversal or a bearish correction or a bearish move. Okay. So that is the indication. So that's what we call a bearish divergence. All right. That's what we call a bearish divergence. Don't worry, I'm going to show us examples on the price chart. Okay, so let's now look at bullish divergence. All right, bullish divergence. Now, bullish divergence is when you have the price. Bullish divergence, let me put maybe type definition. Bullish divergence is when you have the price giving us what? A lower low, okay, or flat low. We can also call double bottom. The other one is double top. That means you can see as we have double top here or a flat top. But this one we can call it maybe double bottom or a flat bottom. You can see how it looks like. And the momentum instead now has a higher low. That's what we call a bullish divergence. All right. So let's see how it looks like on the chart. Let's illustrate it. All right. So we still have our, of course, overbought over. So let me leave them there. And so as for the price is, of course, moving up and down like that. And then normally we're supposed to have the momentum also moving up and down like that. No, just like this. Okay, let's now say at some point, price comes down here and give us a lower low like this. Okay, on the chart. Now, instead of the momentum indicator to give us a lower low, it now gives us around the oversold region. It now gives us a what? A higher low. Okay, let me. Okay, now price gives us what? A lower low. This is a low and a low. This one is lower than this one, but this one is giving us a low and a low, but this one is higher than this one. Can you see that? That is a bullish divergence. So that such that when you connect the two lows here, it's sloping downwards. But when you connect the two lows here, that's sloping upwards. Okay, but preferably around the um oversold region. Now that is what we call a bullish divergence, and it's a bullish signal on the chart. All right, it's a bullish signal. And the variety of that is that, let's say price just continues to go up again, and then now comes here to give us a flat bottom like this. All right. But the momentum indicator, instead of giving us a flat bottom, it now gives us what? Another, it now gives us a higher, the bottom like this, a higher high. Okay, so in this case, we have a flat low here, and then we have this one, a higher low. Okay, flat low and a higher low. This one is a lower low and a higher low. A lower low price, a higher low momentum. Okay, or a flat low price and a higher low momentum. Okay, so that is divergence. You can see that the movement on the momentum is the same. Why the price could have I mean, two varieties like this, whether it's as lower low or flat low, or it has higher high or flat high. All right, for the other one. Okay, so this is a bullish momentum, which is an indication for a bullish movement like this or like this. All right. So what we're going to do next now is, of course, you guys will have to confirm to me that you understand this perfectly. What we're going to do now is to look for, just check our charts, look for the different examples of this indicator, and okay, look for different examples of this indicator. So, but before we go to that place, let me know if you have been able to grab this one very well. We know what a bullish divergence is. Because it's really very important, because it's going to be one of the ingredients, all right, for the strategy we want to build. So, but let me know, please let me know. It's just the opposite of the bearish divergence. So, but please confirm that this is cool, and we can move on and look for examples. Please confirm, all right? So if you get it, just type 1. You can just type 1, all right? I just type 1, 1, 1, 1. Let me just see the ones and ones and ones and ones. I want to see the ones from everybody. Okay, so let's look at some examples. Okay, I hope we can all see my MetaTrader 4. So I'm sharing my MetaTrader 4 with us. Okay, thank you very much, that's cool. So can we all see my MetaTrader 4? So what we're going to do, we're just going to look at the divergence randomly. We're not trying to use it in any way. We just want to look at it randomly, identify where they are, and then put our our lines there. Okay. So let's look at some of them. When you look at here, let me grab this thing. When you look at what we're getting here, price was going up higher high, and when it got here, you can see that it still maintained that higher high. But one thing is, as it makes this high here, it goes and makes another high. That's higher high. But what happened here? We didn't get a higher high here. Instead, we get a lower high. In that case, what we have there is a divergence. So this one slopes up. Why this one does what? Slopes down. That's a bearish divergence. So you have a higher high and a lower high momentum. We haven't one at the top here, and you can see price just moved down a bit, and it didn't really move well. Why? Because it's in the direction of the trend. Okay. When the price is trending up, we want to look for bullish signal, not bearish signal. Okay. Now look at this one also. We have another one. The price is making a higher high here, and at the top of the RSI here, what do we have? A lower high. That's divergence. And price is currently moving down a little bit. Here also, of course, we have a divergence here, but didn't really happen very well at the 30, but it's very close to it. There's another divergence there. A price moved. The cancel price moved up here. Why? Because it's in a bullish trend. So you look for bullish signals. Also here, we have this move down from here. I'm just picking all of them at random. You can see the lower low there, and then you can see this. Okay, it's not that flat. It's higher low, and price moves up, right? We can see another divergence here. This higher high here on the price, a bearish divergence. Now, this is a lower high on the price, bearish divergence. Price moves down. Okay, this is a bullish divergence, a bearish, a bullish. You can see that. So just connect the lines and then you'll see. So this, what we are trying to do, you need to really practice it, okay, and see it for yourself. Not you just believing what I'm telling you, but you also bring up your chart and check those things by yourself. It's what you can see on the chart. So is the MT4 is available for everybody. All right. So we have another divergence here. Okay. While this one is trending up, this one is sloping down at the top. We don't have any divergence here. All right. What we have here is a higher low like this on the price and also a higher low on the momentum. So not a divergence. So we have another divergence here. We have a higher high here and a lower high divergence, right? We have another divergence here as well. Here we have a lower low and then we have a flat low. Flat low, divergence, bullish divergence. We don't have a divergence here. Price makes a higher high around here, and we also have momentum makes a higher high as well. Okay. Here we don't have a divergence also. Price is making lower low here, and momentum is also making slightly lower low here. So there needs to be a divergence. Here we have a very tiny divergence. Price making higher high here. You can see, and the momentum is making lower high there. Very tiny, small divergence there. If you check the lower time frame 5 minutes, you're going to see it bigger. All right, so this is a bearish divergence. Price making higher high, momentum making a lower high. So the examples are there on your chart. You can see it for yourself. This one price is making lower low and the momentum is making higher low. That's divergence. Price moves up. And this one is really a very good signal because it's in the direction of the trend. All right. So another divergence here, right? Price is making a higher high here. The momentum is kind of flat. That's another variety we should have discussed. Okay, that sometimes momentum can also be flat while the price trends. Price makes higher high, momentum is flat, or momentum makes lower low and price is flat at the top. That's a bearish divergence also. And another bearish divergence here, higher high, and this one is lower high. Okay, so those are divergences, all right? Just check your chart, you're going to see them everywhere. Okay, so let's go back to the slide and let me try to incorporate what I just talked about now. Okay, so what we talked about is that, okay, maybe I should put the definition again for you guys. Let me take these ones away. So for a bullish divergence, what you want to see is price making a lower low or a flat low and moment, of course, or price making, okay, let's look at different combination. I'll use price making a lower low, okay, and what momentum is making what a higher low. That's one. Or price can be making a flat low, call it FL, and momentum making a what higher low. And also price could be making a higher low while the momentum okay, let me say, okay, a lower low rather. Let's say it's making a lower low, while the momentum makes flat low. So what we're saying is, price comes just like the example that we saw earlier. So price is making a lower low like this, okay, and the momentum is now flat. All right. So these are the different varieties of a bullish divergence. And for a bearish divergence, so please take note of all these things. For a bearish divergence, you could have price making a what? Higher, right? Higher high, and momentum making a what? Lower high. That's one. Number two, you could have price making a flat high. That's like a double top. And the momentum could be making of course a lower high also. Or you could have price making higher high and then momentum making what? A flat high. So those are the different varieties. But what you're just going to notice is that they at the top, the two of them are not swinging the same. Okay, there's a divergence in the way they behave at the very top. Right. So I hope that you'll be able to apply this, okay, on your own. I'll be able to identify because divergence is such a very, very strong technical tools that a majority of traders make use of, whether fundamental or technical. So even if you are not going to, whatever strategy we're going to learn, even if you later in the future, you divert into something else, divergence is always going to be one tool, okay, that you can always use. Remember, these are just ingredients. I'm not saying you should trade divergence on its own. So you won't just go to your chart and be trading just divergence, okay? Divergence is a tool, it's just an ingredient. So we have to put all those things together, cook them, and crystallize them into a trading strategy that will have rules, so that we'll be able to know what to buy or what to sell and where to buy or where to sell them. All right. So that's what we're trying to do. So I'm not saying you should just go to your chart and be trading divergences the way they are just alone. I'm not advising that. So, but you can just go to your chart and check those divergences, okay, so that you can get yourself familiar with them. All right. So that is it about the definitions of divergence. Okay, now, so let's see. So now, what's the essence of doing all of these things? Remember, the basis of our trade is still trending. All right. Trend corrections, trend corrections, trend correction. And what we want to do is to trade in the direction of the impulses. Can you see that? These are we want to trade these ones. We don't want to trade these ones, right? Why? Because they are small. We want to trade these big moves so that when we risk, let's say $20, we'll be able to make $50, $60 back. That's what we want to do. That's the way you should approach trading. All right. So when you do that, when you trade that way, you don't have to have a very high winning rate. You don't have to win 70% of your trade before you make money. No, you don't have to do that. Once you are able to win 50% of your trade, you will do very, very well. Why? Because when you make profit, your profit are far bigger than the losses you're making. I'm going to, at the end of this, I'm going to show you the strategy we learned because I've been trading it for since June. I'm going to show you the June results, July results, August results. August is about to end. So 3-month results, and it has done over 80%. Okay, on a well managed this thing. So I'm going to show us so that you know that this what I'm trying to teach you guys is not something that I don't use. Okay, it's something that I apply personally to my trades also. And it's just one of the 5 strategies that I know. Okay. And it's actually okay. Let me not go in there. Let me just let me not let me not go in there. All right. So that's just it. So what we want to do is that we want to number one, determine the trend. We want to know once you check a chart, the first thing we want to know is that what is the trend. Remember, we want to trade trends. If it's not in a trend, then we are not interested. I'm also going to show you later how you can avoid trading a non-trending market. I'm going to show you all that when we are done with the strategy that I want to learn. Okay, so first thing is you want to know that the market is trending. If you know the market is trending, we now ask what direction. If it's in a bullish direction, that we're looking forward to buy. If it's in a bearish direction, we'll look forward to sell. And what tool do we use for the trend? Moving average. I'm going to show you the combinations we're going to use. And number two, and then the second thing is after we have identified the trend, we wait for correction. That's what we want to do. Remember, we are following this model, impulse correction, impulse correction. So we want to wait for this correction. Okay, so that we can sell the next impulse in a bearish market. If it's a bullish market, we want to wait for these corrections, this correction, this one, we want to wait for it, that we can buy the next impulse, wait for this, buy the next impulse. So that's the model, that's the foundation. That's why at the beginning I discussed this foundation with us, okay? The model. So we're waiting for correction. So once the correction starts, we now make use of our tools to help us to know where and when the correction is going to end. Where the correction is going to end. We're also going to use that. We're also going to make use of our moving average. Okay, when the correction is going to end, we're going to make use of our RSI or the stochastic, anyone you want to use, and how the correction is going to end. We're going to make use of our divergence. So there's going to come a point when these three reasons are fused together. The three of them are telling us that the correction has ended, right? This is going to be the last one. Okay, this one and this one, one might come before the other, but this is going to be the last one. We're not going to apply this divergence when we have already identified that the correction has gotten to the place where it's supposed to end, and when we're able to, and it has already ended. That means the correction has become exhausted with RSI. Then we can use our divergence to spot to complete this whole thing. And then we can now trade the next impulse. All right. So that's why we put all of these things together. All right. And so that's it. So we won't really have so much time for that today, because I really want tonight's class to be short. Don't want it to be too long. So on Wednesday, that's where we're going to put all of these things together, and then we're going to learn a complete strategy. Okay, on Wednesday. And but before we move on, before we end today's class, before we move to the question and answer session. Now let me paint a picture to us, because when people hear about trading, they have all sort of misconception when it comes to trading. And that's why trading is actually much more than strategy. All right. Trading is a way of life, so to speak. Is behavioral in nature. Is is an emotional and it's very psychological business, and that's why it's very, very hard for a lot of people to succeed in it. People lose money, or most people will lose money. They lose money not because they don't have a good strategy. In fact, majority of the strategy outside there work. So there's no strategy which is the king or whatever. Majority of the strategies there work. Your own is just to pick the one that fits your person and use it well. So majority of traders will lose money. They do so because not because they don't have a good strategy, but they are too emotional. We are emotional people. When we lose trade, before we place a trade, we are afraid, fear. When the trade is going in our favor, we are still afraid, right? You're afraid when the trade is going in your favor. You're afraid that it might go against me. The money may just go now. The profit I make. Fear of losing the money fear of losing your profit is a fear. Fear of losing capital is a fear when a trade is going on. Now, when you are doing well and you are trading fine, you're making money, greed sets in. You become greedy. That's it. You become greedy. And let's say, apart from greed, when you are doing well, because maybe at some point you are not really doing as well as before, greed can set in, or revenge. Okay, revenge is when you are not really exactly doing the way you used to do before, and which is normal for every trader. I'm going to show you the result now so that you see that it's not the same amount of profit you'll be making every month. So let's say you make maybe 30% the first month, or maybe 40% the first month, second month 30, maybe you are used to it. And then the third month, you are really struggling to even make 5-7%. It's normal. Okay, because the profits are not really going to be constant month-on-month basis. And so when that happens, a lot of people want to start doing revenge trading. They want to know, I must get this month, I must get this. So they start doing revenge trading. A lot of them, when they are doing fine, they start getting so greedy. They want to take more and take more and take more and take more, you know. So emotion is the problem of the major problems that traders have. And how do we overcome this emotion? Is by knowing them ahead of time, know what kind of emotion we're going to encounter at the beginning. Now, I'm saying this because if the strategy that works, you can actually train 10 people. How many of us now? Okay, let's say we have 10 people, for example, and you train them the same thing. Let's say they don't know anything about the market, and you train them very well, and you give them the same thing, the same knowledge, the same strategy. You're going to discover that after a while, when they started trading, they're going to have different results. All right. They're going to have different results. And it's just because of the emotion. All right. The emotion and some really, really bad emotion that make trader to lose money. Fear, greed, impatience. They are not patient. They just want to. So we're going to talk about all those things later. Okay. I just want us to understand that trading is not just about the strategy. It's also about your risk management, and also it's about your psychology, how well you can manage your emotion. Okay. So when it now comes to trading, a lot of people have this misconception on what trading should look like, what successful trading should look like. A lot of them believe that professional traders who are making money, they win all of their trades. That's a lie. One thing you need to know is that it's not possible. You're never going to win any of your trade. If you know you want, I mean, you're never going to win all of your trade. If you know that you must win all of your trade, I beg you, please quit, because this is not a business where you win all the time or trade on trade basis. No, it's not possible. 0%. Don't think about it. All right. Don't. If you want to, if there is no, if you have to win 100%, you must win 100% before you can consider yourself a good trader. You are going to lose money here. It's not going to work. So you have to understand that first. Settle that at the back of your mind, because when traders lose money, they will just cave in and forget about the plans they set. Why? Because they lose a trade. That's You were going to lose trades. That's one. Two, you are going to lose consecutive trades. You can lose 2 consecutive trades, 3 consecutive trades, even 4 consecutive trades. It's possible. I'm going to show you some results now. Okay. It's possible. And you can also win 2 consecutive trades, 3 consecutive trades. You don't really exactly not going to know. You won't exactly know how your trading distribution is going to be, whether you're going to have 2 consecutive wins, 2 consecutive winning trades, or 3 consecutive winning trades, or wherever. You don't know. Your own is just to trade your plan. Okay. But most traders find this, most beginning traders find this very, very hard to do. Okay. So once you have a strategy that you can win, let's say 40 to 60% on 1 to 2 or 1 to 2.5 or 1 to 3 risk reward. That's what you need. If you can get something better than this, fine. Okay. But if you can get this, perfect. And the strategy I want to teach you guys is the one that can give you 1 to 3 winners on, 1 to 3 risk reward ratio on, to give you like 50% winning rate. So don't have too much expectation, like because it's Mr. Something that is teaching that we're going to win all of our trades. No. Okay. So I'm just trying to prepare our mind. All right. So I'm going to stop this recording here now, and then we're going to take the discussion further. So thank you very much, guys.